Hello and welcome to On the Money, a weekly look how to get the best out of your savings and investments. In this episode, we're going to be covering the key personal finance announcements that were made by Chancellor Rachel Reeves in her Mansion House speech, which took place on the evening of the 15th of July. And we're also going to be talking about which policies didn't crop up in the speech but remain in the government sites. Joining me to discuss this topic is Craig Rickman, Personal Finance Editor at Interact Investor. Now, before we get into the detail, I just wanted to flag that we're recording this podcast remotely shortly after the speech was made in order to have the podcast published as usual on a Thursday. And also just to be aware that the information that we're providing is based on what we had available to us at the time of this recording. So, Craig, before we delve into it all, let's start off with what is the Mansion House speech and why does it matter from a personal finance perspective?
Yeah, sure. So simply put, it's an annual address and an opportunity for the government to outline its plans and visions for the financial sector. So in terms of the content, what does this involve? So this typically includes things like regulation, pension and savings policy, housing reforms, and that kind of thing. So it's essentially the government's way of saying, this is what we're going to do to make things better, to improve the way things work, to boost the UK economy. So if the Chancellor does announce changes, and we saw some yesterday, they typically do affect us in some shape or form in terms of how we save, how we invest, and how we borrow. It's not to be confused with a budget. It's not a fiscal event, but it is important to keep an eye on the Mansion House speeches, what's going on and the reforms that have been put forward. There was a lot of speculation before this speech, mainly around ISAs. Some of the original reports didn't come to pass, but there were still some reforms that will impact how we interact with our finances.
So, in terms of the contents of the speech, the key takeaway from a personal finance perspective was the announcement of an ambition from the government to make Britain more of a nation of investors. So, Chancellor Rachel Reeves announced in the speech that investment is presented in too negative a light and argued that there's been too much focus on risk in investing. She said, for too long, we have presented investments in too negative a light, quick to warn people of the risks without giving proper weight to the benefits. It was also announced that there will be a campaign to promote the benefits of retail investment, and that campaign will launch next April. And there will also be a brand new type of targeted support for consumers ahead of the new financial year. Craig, could you explain more about this brand new type of targeted support for consumers?
Yeah, sure. So this targeted support is something that was launched by the Financial Conduct Authority, the city watchdog. There was some draft rules on this published a few weeks ago. And the idea of this is that will enable financial providers to suggest appropriate products and strategies to consumers with similar circumstances and characteristics. And this has been given the green light, as you say, from April 2026. This is potentially could be a big change to the way that people interact with their finances. You can sort of think of it as a middle ground between basic guidance and regulated financial advice. So it's some extra assistance with life's big financial decisions, a nudge, if you like, without it being a personalized recommendation. I think the FCA and the government are concerned that less than 9% of adults access financial advice. So, fewer than 1 in 10 people. And there's a quote here, and their concern is that many are turning to informal and unregulated sources of guidance, such as social media. So the idea here is to try and help people make better financial decisions or steer them towards them. So I think on the whole, it's a good thing. I guess the government in its Mansion House speech answered one of the key questions around this, which is when will it be available from? So we've got the answer to that. A consultation on targeted support is still running. And so we should learn a little bit more about how it's going to work over the coming months. But I feel this could have a really positive impact on consumers, namely to make sure that, well, not necessarily to make sure, but to give them sort of more steer towards financial decisions which might be more appropriate for them than potentially what they're doing at the moment.
In terms of the comments made by Rachel Reeves regarding the overemphasis on risk and not enough emphasis on the benefits of investing, that's music to my ears. I've been working in the sector for over 15 years now, and over the years I've had many a conversation with friends about the merits of investing. However, the first thing that always crops up is risk. And a lot of what my friends will say, well, isn't there a lot of risk involved with investing? However, of course, this is a misconception. If you are investing for the long term and you have diversification in terms of what you're investing in your portfolio, over the long term, the figures show that the best route to try and grow your wealth ahead of inflation is to invest it, and also to invest it in growth assets, such as funds that invest in shares. Whereas if you leave it in cash, over the long term, cash is eroded by inflation. So I'm really interested to see how the government's attempts to tackle this dilemma in trying to switch a greater emphasis on encouraging people to think about the merits of investing rather than being put off by the fact that there's a possibility that the value of your capital can fall. I touched on diversification, and that is one of the key ways that investors can reduce risk by investing in a range of different types of investments, different types of funds. This gives a portfolio diversification. And what happens here is that when there are short-term periods in which stock markets are volatile, which of course can happen, a diversified portfolio helps to safeguard returns, and it also gives the portfolio plenty of scope to grow over the long term. When it comes to risk, volatility is par for the course of investing in the stock market. We've of course seen very recently stock markets fall in response to US tariffs. And prior to that, the COVID-19 pandemic caused global stock markets to fall suddenly over a short time period. And if you go back even further, of course, there was the financial crisis in 2007 and 2008. At the turn of the millennium, there was the tech bubble that spectacularly popped. But over the long term, stock markets do tend to recover and do tend to reward patient investors that are investing for the long term. If you look at a very long-term chart of a major stock market index, such as the MSCI World, S&P 500, or the FTSE 100, of course, you're going to see that there's been some bumps in the road. But over a 10, 20, 30-year period, those bumps are actually not that big, looking on a chart in the grand scheme of things. And over the long term, stock markets do tend to be wealth machines. Of course, the trouble is there's no guarantees with investing. There's no guarantees that a return will be made. There's the prospect of capital loss, depending on what you invest in and how long you invest in that investment for. And that's why there has to be risk warnings on investment literature, including for funds that highlight that fact. However, Reeves announced that there will be action to look at our current approach to risk warnings, and that'll be reported back in January. Craig, what are your thoughts on this risk warning review? Is it one that you welcome?
Yes, couldn't agree more. I think there's this perception among sort of certain sections of society that keeping your money in cash is safe and investing in the stock market is a gamble. But as you've alluded to, and as a lot of the data shows, when sort of looking at your long-term future, keeping your money in cash tends to be the biggest gamble because there's a risk that your money isn't going to keep pace with inflation and will erode in real terms. So I think the government's decision, or Rachel Reeves' decision, to examine risk warnings and try and sort of look at flagging the benefits is a really, really important and needed move.
Let's now turn our attention to ISAs. So, reforms to cash ISAs were heavily touted ahead of the Mansion House speech. The expectation was that Rachel Reeves was giving a lot of thought to cutting the yearly cash ISA allowance from 20,000 to 4,000. So, thinking from the government here was that if there's less scope to save into a cash ISA every year, then more money may then flow into the stocks and shares ISA version. And this would improve consumer outcomes and also boost the UK stock market. So the cash ISA alongside the stocks and shares ISA, they are the two most popular ISA types. However, cash ISA account openings do trump the stocks and shares ISA version. So just give you an example of that. In the 2022 to 2023 tax year, 7.8 million people took out a cash ISA, and this was more than double the 3.8 million people that took out a stocks and shares ISA. However, before the speech started, Craig, the Financial Times got the scoop that those rumoured plans to cut the cash ISA allowance have been put on the back burner for now. In the actual speech, ISAs did get a small mention. Reeves said, "I'll continue to consider further changes to ISAs, engaging widely in the coming months." And she also said, "I recognise the potential for ISA reform to improve returns for savers and access capital for UK businesses." Craig, we've only got that short quote to go off, but it does appear that the ISA system could still be reformed.
Yes, absolutely. I think I would. My view is that a cut to the cash ISA limit, which that it was hugely divisive, or is a hugely divisive issue, as we saw in the lead up to the speech. But I don't think that the prospect of that has disappeared. I think it's on the table, but it seems the government is perhaps giving itself a bit more time to liaise with the industry, to work out whether it's the right thing to do or not. And I think that's a sensible move, if only to avert another, potentially embarrassing U-turn. So I don't think that is, the government could revisit that at some point. But there was some clear signalling towards reform to the ISA landscape, and I think, there have been lots of people, lots of companies urging the government to simplify things. Because as things stand, there are currently 6 ISAs in operation, and 5 are open to new subscribers. But the thinking is that's a bit messy, and we need to make things easier for people to choose the right one. I guess, namely for this, choosing the right one between cash and stocks and shares, as you note, are by far the two most popular types. So it very much seems like further ISA reform is in train.
So my personal view, which I know you also share, Craig, is that a simpler ISA system, and potentially less of them, will help break down the barrier of complexity. And if it is a simpler system, that'll hopefully then encourage more people to engage with the merits of investing over the long term. My views on the cash ISA is that it's a useful way to put money in to build an emergency fund, which as a rule of thumb is 3 to 6 months of salary in cash that you can access quickly to utilise if you, for example, unfortunately are made redundant, or to fix a major problem, such as repairing a roof or getting a new boiler. But in terms of growing wealth over the long term, as I mentioned earlier, investing is the key piece of the jigsaw in order to grow wealth, and ideally investing in growth assets, such as funds that invest in shares. However, while all these reforms are certainly welcomed, I do think what would really help to get more people investing is if stamp duty on UK shares was removed. This is an unnecessary barrier to investing in our own home market. At Interactive Investor, we've been very vocal for a long time in calling on stamp duty being removed. And in response to the Mansion House speech, Interactive Investors Chief Executive Richard Wilson said, "Stamp duty on stocks and shares is a tax on backing British business, and scrapping it should be the cornerstone of any serious reform. It's lose-lose. It's a charge on confidence, a tax on participation, a drag on liquidity. It makes investing in UK companies more expensive than it should be and sends the wrong signal about where we want people to put their money. We've heard time and time again that the government wants to boost long-term investing. Now it needs to back those words with substance. Getting rid of stamp duty on shares is one of the fastest, simplest and boldest things this government could do to shift the dial." And just to add another point, our own research shows strong support for the removal of stamp duty. So research by Interactive Investor found that 72% of retail investors would be more likely to invest in UK shares and investment trusts if stamp duty was scrapped, compared to just 7% who said lowering the cash ISA allowance would have an impact. Now, while there was no cash ISA announcement, there was an ISA-related announcement made before the speech. And that announcement was that a fund structure called Long-Term Asset Funds, LTAFs, will, from the start of the next tax year, so April 2026, be allowed to be held in stocks and shares ISAs. So this fund type can already be held in the Innovative Finance ISA, which was designed for peer-to-peer loans and other less liquid investments. Now, for those not that familiar with this fund structure, so LTAFs invest in illiquid assets, such as private equity and infrastructure products. They were initially intended for pension funds or sophisticated private investors, but it now appears that retail investors are being targeted. Now, one of the big differences between an LTAF and an open-ended fund is that an LTAF has notice periods, and these notice periods are typically a minimum of 90 days. So therefore, if you're in a hurry for your money, you won't be able to access it quickly, whereas open-ended funds offer daily dealing. Now, the reason why these funds have notice periods is because illiquid assets are hard to sell quickly. And by having notice periods, they protect investors from the risk that a lot of money exits at the same time if a lot of investors are asking for their money back all at once. As if they don't have these notice periods, then the investments will have to be sold. There'll be a fire sale of assets, and then the underlying value of those investments will be sold potentially too cheaply versus their actual value, and then that'll harm the remaining investors in the fund. For me, as with any fund, it's important to look under the bonnet, understand what an LTAF is investing in, and also be comfortable with the fact that LTAFs have these notice periods, as I think fund investors at the moment are very used to having daily dealing. So that is definitely something that an investor would need to get their heads around when considering the LTAF fund structure. Craig, any further thoughts on LTAFs?
I think what's interesting about it is that, as you note, LTAFs are only currently available in the Innovative Finance ISA, which compared to the cash type and the stocks and shares type makes up a really tiny part of the ISA market. So in the 22-23 tax year, there are only 17,000 innovative finance ISAs taken out. And that compares to sort of in the same year was just under 8 million cash ISAs and just under 4 million stocks and shares ISAs. So it makes up a fraction of the ISA market. And I guess allowing assets that were previously reserved for that type of ISA and allowing those within the stocks and shares version could suggest that perhaps the government is looking to simplify things. And perhaps move towards a sort of a slimmer ISA landscape and perhaps thin some of the herd. But that's just a thought at this stage, and we'll have to find out what the government ultimately is going to do with this.
And for the final section of the podcast, Craig, let's now move on to pensions. So ahead of the speech, there was lots of speculation regarding auto-enrollment rates being potentially raised, but there were not any mentions of this in the speech. Now, while there were no new reforms for pensions mentioned in the speech, the Chancellor did point out her aim of ensuring that British savers benefit from the success of fast-growing businesses. Craig, this again fits into the government's aims to try and get Britain investing and in turn boost the UK stock market.
Absolutely, yeah. That's been the theme, very much throughout, Labour's return to power, and particularly with pension schemes. It's not just about getting more people investing, but trying to funnel more money into UK assets. We didn't hear anything else about pensions. There were reports that the government was looking at auto-enrolment, the workplace pension system, namely whether to start a consultation to consider jacking up the minimum amounts, which are currently 8% of qualifying earnings. So employees pay 5%, employers pay 3%. But the thinking is that that is probably not enough for most people to secure a comfortable retirement. And so the government is looking at this. We know that it's on the government's radar as part of phase 2 of its landmark pensions review. So we'll come onto it at some point. There are some big decisions to make around that because, if you were to increase auto-enrolment contributions, and that's an extra cost for staff who are still feeling the pinch from the rising cost of living, and also employers too, who have faced some additional costs in recent years in the form of tax rises and the minimum wage increase. So we didn't hear anything about that. We also didn't hear anything about self-employed pensions. There's quite a worrying low uptick of pensions among self-employed workers, and we know that's something the government is keen to address too. Those were two areas that were reported in the lead up to the Mansion House speech, and something that we could learn more about. We didn't get that, but we will hear more about those two areas and what the government is going to do there at some point.
So we've now covered off all of the personal finance announcements that were made in the Mansion House speech. Before we go, going back to what Craig said at the start, the Mansion House speech is not the forum for introducing major changes to the tax system. However, we do have the autumn budget coming up. I'm sure there's going to be plenty of rumours about the fiscal rules that are in place at the moment and about whether there will be any tax changes during that budget. We will, of course, on our On the Money podcast, cover the autumn budget later on in the year. We may also do a preview of the budget ahead of it. My thanks to Craig, and thank you for listening to this episode of On the Money. If you enjoyed it, please do follow the show in your podcast app and do tell a friend about it. And if you get a chance, please leave a review or a rating in your podcast app too. We'd love to hear from you. You can get in touch by emailing otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, ii.co.uk. And I'll see you next week.